On the one hand, inflation is still well above the 2% target. It is possible that it could be sticky. For example, if increases in administered prices were repeated or if labour cost pressures continued to be elevated. There is a risk that the inflationary shocks we have had could have affected inflation expectations and the way wages and prices are determined in the economy. That could lead to more inflationary pressure. A scenario in the report illustrates that the path of bank rate might have to be higher than otherwise in response to that. On the other hand, activity in the economy is below its potential. We see this most clearly in the labour market, where the number of vacancies has fallen and employment growth has stalled. There is a risk that households and businesses remain cautious about spending and investment, holding back demand and weighing on job prospects further. And that could lead to inflation falling below our target. A scenario in the report illustrates that the path of bank rate might have to be lower than otherwise in response to that. The monetary policy is being set to balance these risks in order to meet the 2% target sustainably, and so that bank rate is neither too low nor too high. So today's decision is based on two key judgments. The first key judgment is that underlying domestic price and wage pressures are continuing to ease. Recent data suggests that the risk from greater inflation persistence has become less pronounced, and the risk to medium-term inflation from weaker demand more apparent, such that overall risks are now more balanced. As the central projection in the report illustrates and is reflected in the market curve, this means that we are likely to continue to be on a gradual downward path for bank rate.